Welcome back. It's the start of the new year, and I just want to present something interesting that CLSA had spoken about. They're saying the big structural change that they are looking to see in 2023 will be, will India see more dedicated foreign flows? So basically, if you analyze the foreign flows into India, 95% of it is not dedicated into India. It comes in via the emerging market funds. It comes in via, those MSCI emerging market funds or global funds, etc. They're not specifically for India per se. 95% of them are non-India dedicated fund. And they're saying, can that number increase, come down from 95%? Can we see an increase in the number of funds which are dedicated to India? And one of the reasons which they highlight is the depth of the Indian market is improving. The number of billion-dollar companies in India is the fourth highest in the world. It's behind only US, China and Japan. And these markets attract flows of their own. So as the depth of the Indian market continues to rise, and as more and more tech companies, these new age tech companies list, you will see more of these billion-dollar companies, more of the depth in the market increases, and perhaps India will be able to attract its own dedicated flows. So that is the structural change that CLSA will be watching out to see in 2023. But let's pose this question forward and the outlook for the next year with Satish Ramanathan, CIO Equity at JM Financial Asset Management. Satish, morning. Thanks so much for joining in. Rima here. Tell us, what is your outlook for 2023? What would be the key things that you would be tracking now?
Good morning, and thanks for having me on air. In 2023, we expect it to be a little more stock specific. In 2022, we had the base effect playing out for the entire market. There was a positive tailwind coming through. And what we expect in 2023 is that we have to delve deeper and pick out stocks that are likely to be winners. It's going to be a little more challenging for the fund management team. But I think 2023 is going to be all about that, where we see pockets of value, where we could hunt for growth with a reasonable value left on the table. That would be 2023.
Where do you see growth then? Because, this has been a very tricky year, right? I mean, a year when shorting IT and going long on banks was perhaps the best strategy. What do you see as the big strategy in 2023?
I think the banks will continue to have their earnings momentum. Credit growth is coming off a very low base and asset quality is good, and therefore provisioning costs are low. They would find tightness in the markets to raise money, but we think spreads could expand as well because the borrowers will have to pay more for borrowing money. That's going to be the central theme for the first half of this year, banking sector to do reasonably well. We also expect manufacturing and infrastructure stocks to perform reasonably well because the momentum is strong. We are seeing railway capex on a strong momentum, and we see that continuing. So it's just that we need to wait and watch if we can use volatility to fine-tune our entry point into these stocks. But the story remains the same.
All right. Hi, Mr. Ramanathan. Good morning. This is Pavitra. Even as this has been a tricky year, there definitely have been pockets which have stood out here, right? So you mentioned the banks, but something like defense has done well. You have some of the railway stocks which have done well. Do you find value in any of these?
In terms of value, I think the deep value that we saw in many of these stocks have gone. But can we just probably remain there and grow with the companies? Yes, that's definitely true. Markets are a little stretched in terms of valuations. So probably this bout of volatility that we saw and the nervousness that we saw due to COVID in China is something reflective of the nervousness in the market. And therefore, we think that we need to be a little cautious in terms of allocating lump sum, but SIPs should be the way to go in averaging your entry points.
Satish, I know you're bullish on financials, but so is the rest of the world as well, right? This is turning out to be a consensus overweight across retailers as well as investors. Do you think banks are likely to do well, but can they outperform? Because now everyone is expecting them to outperform, and once the narrative is firmly set in, the price action follows immediately, and we've seen banks outperform. So my simple question is, will banks outperform like the way they did, or do you think they will perform in line with the markets this year in 2023?
Good question, and we ask that ourselves quite often. But the issue is that the visibility of earnings in banking system is far clearer than rest of the market, because you hear narratives of slowdown in consumption, you hear narratives of electric vehicles eating into two-wheeler demand. So there's a lot of the structural bets that we used to take earlier. All of them are seeing some kind of volatility coming through in our base assumptions. In that context, financials, which is already 40% of earnings and far higher of incremental earnings growth, will continue to outperform till we find a new winner amongst the sectors that we are talking about.
Any sectors that you would keep away from, sectors that perhaps could be on the back foot this year?
Not really, but perhaps consumption could be something which had an early rally last year. It could be more into services rather than base consumption of FMCG and toiletries kind of a thing, because people are going out more often. So we would look at services and consumption-oriented services. That would be the likely winner going ahead.
Okay, got that. I just want to ask you about the mid-cap and small-cap part of the market as well. Of course, today it's doing very well, but in the past week we did see quite a correction after that huge run-up. How do you think this part is likely to fare?
So if we look at a one-year return, large caps are plus 5% or 6%, and small caps are minus 5%, and mid-cap in between. Now, structurally, we think mid-caps are the way to go because stock selection is possible there. We can also pick up long-term growth winners there. And if indeed India-dedicated funds, as you mentioned earlier, do come in, mid-caps would be the hunting ground. So we think mid-caps is the way to go. And as regards small caps, we think volatility would be linked to inflows from the retail market, because large fund houses and large foreign institutional investors don't play in that segment of the market as much as they do in large and mid cap. So in terms of small cap, we think volatility will continue and one needs to be cautious. The second thing that we need to also bear in mind is that interest rates have gone up for the investor, and consequently that's something which means that the investor can allocate money into fixed deposits or other debt securities, which makes it a little less risk averse for investors to move their money there. So I think that's on a balance, that's the autocorrect mechanism that we have in the markets going today.
Okay, all right. We'll leave it at that. Thanks a lot for joining in and taking us through your views on the index and the way forward. Happy New Year to you in advance, and hope to speak to you very soon on CNBC TV18. Well, the market has extended its gains